Hi traders, today we're talking about the top 5 mistakes when multi-time frame trading or with multiple time frame confluence. After this video, you'll be able to identify some common mistakes made by traders and be better able to evaluate a new strategy. If you want to watch my video on how to trade with multi-time frame confluence, it will be in the description below, or you can just click on the card above. Problem 1. Analysis paralysis and hopping between different time frames. When you're forming a strategy for trading with multi-time frame analysis, you choose one set of time frames and use them. That could be 4-hour with entries on the 1-hour charts, a 1-hour with entries on the 15-minute charts, or a weekly chart with entries on the daily charts. The choice is yours. Don't hop between different sets of time frames, constantly looking at possibly getting a better setup. This will result in hours of frustration. Once you identify a combination of time frames you want to trade, focus on them, and this will make you a more proficient, focused trader. Problem 2. Trading too low or too short of time frame for confluence to be relevant. Trading short time frames can be a great way to trade if that's part of your trading plan. But many traders make this simple mistake. If you are looking at a 1-hour chart for your trading, whether that be higher highs and higher lows, a specific candlestick pattern, or point of resistance or support in the market, you cannot drill down into too low a time frame for your entry signal. The time frame you are looking at to make an entry in, due to the setup you identified, say on the 1-hour charts, drilling down into the 1-minute charts will be too low. Take a look at the 15-minute charts to have a time frame that is lower and will net you a better entry signal, but not too low that it becomes irrelevant. Problem 3. Using too many time frames as reference. Say you want to make a trade on a 1-hour chart. You see an entry signal and you drill down to the 15-minute chart to see if you can get a better price. Once you're on the 15-minute chart, you drill down even further into the 5-minute charts. From there, you go down even further into the 1-minute tick and range charts. The fact is that this can cause analysis paralysis with multiple time frame confluence. When you are looking at trade setups and actually making the entries, have a lower time frame that you choose as your go-to entry time frame. This will prevent you from further drilling down into lower time frames to attempt to get a slightly better price, when it will actually just cause you to miss trade opportunities. Problem 4. Not outlining possible areas of resistance and support from much higher time frames. This one is pretty specific, but here's a quick example. Say the market you are looking at is moving towards making an all-time high. You're trading on the 4-hour time period and looking at the 1-hour time period for entries. Now, since you trade this market regularly, you already know that the market is approaching an all-time high, and that this may cause resistance in the market. That is multiple time frame analysis, but on a much higher time frame. The time frame of the entire market. Here are a couple key points to mark out on the market every year. The current year's open, this year's high, this year's low, and the all-time high. These are areas that may provide support or resistance in the market. These levels may or may not be part of your trading plan, but they should be noted. I say to mark out these times as reference points because the buyers and sellers are often basing their decisions off of these prior levels. Once the market has progressed through the year, you can even take a look at these areas on your charts and see if they have maintained relevance by seeing if the market stalls around these areas. Problem 5. Not using a simple, free indicator already available on your platform to give you a broader view. This isn't directly multiple time frame analysis, but it's a great way to see the larger picture, which is exactly what multiple time frame analysis is about, the big picture. A simple moving average indicator can give you a broader picture of any time frame you choose, and it's available for free already on your platform. It shows you the trend in that time period in the market. Looking at a daily chart with a 200-day moving average is a great way to understand the trend in the market. Multiple time frame analysis isn't about using this one strategy and nothing else for your entries. This method of trading, confluence, is about improving your odds for every trade you make, combined with your trading strategy. You're going for a better probability on every trade. That was the top 5 things every trader should know about trading multiple time frame confluence. If you want a more detailed video, click the link at the end where I teach you how to understand and approach multiple time frame analysis. If you have any questions or video suggestions, I'm always looking to hear from you. As always, enjoy trading.